So let us begin our lecture 8 summary. So you can see that education the best investment for the society. So public expenditure in country percentage GDP. So in India you can see that 2.7% of the GDP share is given to the education, while in Bhutan and Zimbabwe it is 7.5, and Costa Rica and Finland it is 7, in South Africa, Brazil, Uzbekistan is 6, UK, Netherlands, and Palestine it's 5.5, Malaysia, Kenya, Mongolia, Korea, and US it is 5. Annual, so it is the article you can read it 5%. So school education takes biggest hit. Government cut proposed education spending by 6,000 crore. This is the recent Indian government GDP data on the education, that how much they have cut the education. So you can see that the public expenditure in India, sorry, of GDP percentage for countries like Japan it is 9.2, Brazil 3.9, China with the world's largest population it is only 2.9 percentage of the total GDP. Here you can see that if you talk about India it is recently 1.3% of GDP. Why is that? Um, the percentage share of education as well as the medical is going down, because the government make policies to so that government can show its muscle power to countries like China. So in order to do that, they are increasing the expenditure percentage on the defense sector and cutting down the um, GDP share of medical and health sectors. So you can see that children aged from 12 to 30 receiving full immunization percentage. You can see here. So national income accounting. So there are three approaches: amount of output produced, excluding output used in intermediate stage of production. Output approach, total income generated in the economy. It is income approach, amount of spending by ultimate purpose of output expenditure approach. All three approaches give identical measurements of the amount of the current economic activity. So these are three different approaches to calculate the GDP. And according to the given condition, we will use these approaches. So output production method, in this gross value added output of final goods and services minus intermediate consumption. So GDP equals to gross value added plus indirect taxes minus subsidies. We can say that indirect taxes minus subsidies, they are net indirect taxes. And income method, we will see that national income is total rent plus wages plus total interest plus total profit. And consumption, GDP equals to consumption expenditure, consumption for consumer, sorry, and for entrepreneurs is called investment, and by government. Why value added? Suppose there are n firms in an economy. Output for the I firm is Qi, and the price that this firm charges is Pi, the value of the firm's output. The total value of all the n firms output. So we can find out that it will be Pi Qi, for all the n firms we will add all these. The concept of value added. So Suppose uh, cotton is produced at $1, and by using that we produces good, and it is also its price become $5, and from that if we include the tailor's art to in making shirt, so its final value becomes $12, and if his that shirt is sold on retailer as a final good, its price is 20. So everything got added. So 1 plus 4 plus 7 plus 8, that is total 20. So in GDP we will calculate this 20, not this 20 plus 12 plus 5 plus 1, because they are the intermediate goods. Suppose that there are only two business houses, Tata and Birla. Tata owns and operates oranges orchards, the Orange City and Nagpur. It sells to the oranges directly to the public in the market and sell the rest to the Birla, which then produces and sells orange juices in the market. So Tata, wages paid to the employees, that is 15,000, taxes paid to the government, that is 5,000, revenue received from the sales of oranges, that is 35,000, oranges sold to the public, that is 10,000, oranges sold to the Birla, that is 25,000. And what the Birla do? They make they wages paid to the employees 10,000, tax pays 2,000, foreign purchases 25,000, revenue from the sale of orange juice, that is 40,000. So the product approach, value added approach. The value added approach of a producer is the value of its output minus the value of the intermediate input it purchases from the producers. So because if we in GDP, if we add uh, Tata and Birla's both, so what will happen that in this case, without excluding the intermediate inputs, the this amount 25, suppose this amount 25,000 will be added twice in the GDP. So value added approach is the value of its output minus the value of the intermediate inputs it purchases from the producer. So Tata produces oranges worth rupees 35,000. So he uh, produces oranges at 35,000, and Birla produces orange juice of 40,000. However, if we add these two amounts, then we will double count the 25,000 which Birla purchased from Tata. Hence, we will only sum the value added rather than the output data. Birla's value added is 15,000. Tata does not have any input purchased from the other businesses, so its value added equals to its revenue, because it does not produce from the any other businessman. So we will account 35,000 for Tata, and the value added by the Birla in the GDP share, that will be counted as the 15,000, because we will subtract 25,000 from the 40,000. So total value added in the economy will be 50,000. So you can say that the oranges. And if we talk about the income approach, in this we consider the after-tax incomes of the Tata and Birla and the total tax received by the government. So Tata after tax is 15,000, Birla after tax is 3,000, total wage income of employees 25,000, government tax income is 7,000, and if we again add them, it will be 50,000. If we go by the expenditure approach, the house add the amount spent by all the ultimate users of the households are the ultimate users of the oranges. So Birla is not, because finally sells the oranges. to the household. Thus, consumer purchases rupees 10,000 of oranges from the Tata and 40,000 of orange juice from the Burla, so a total sum will be 50,000. So from all these three methods, we will get the total of 50,000 in the economy. So a GDP of all currently domestically produced final goods and services evaluated at market price. It is the definition of GDP. Market transactions such as exchange of previously produced houses, car, factories, and exchange of stocks and bonds and other assets are not included in GDP. Non-market productive activities and the underground economy are left out. So if we want to define GNP, so it is the GDP plus NFIA, that is net factor income from abroad. That is the factor income received from abroad minus the factor income paid abroad. So what happens if NFIA is greater than 0? So GNP will be greater than GDP, that is the case in UK, and in India GDP is greater than the GNP. We can say that in USA NFIA is almost 0. So NFIA is the net interest earning profit and dividends are coming into India from our asset owned overseas matched against the flow of profit and other income from the foreign owned assets located with the India. Many foreign firms have set up production plants here, while India firms have expanded their operations overseas and multi. So this is the GNP and GDP data for Indian economy in different time. You can pause in this read. So GDP includes tangible goods and intangible services. Not GDP includes currently produced goods, not goods produced in the past. So gross national product. The value of all final goods and produce and services produced by a country's factor of production and sold on the market in the given time. So GNP, the definition of GNP, it is not a geographically limited. The GDP is geographically limited because the product produced in the in India, in the geographical region of India, will be accounted in the GDP of India. Rather, we will ignore the fact that the good is produced by Indian or foreigner, but we will just simply add it to the GDP. So, but where in the case of GNP, it is the total production done by the individual of that country in all over the world will account in the GNP. There is some definition, and here we will end our lecture. Here are some examples. You can see this is the equation of GDP. This is the consumption plus investment of good plus government expenditure plus net export. GDP as income. GDP is the sum of total payment to the wage earner, businesses and commerce, etc.